Well, good afternoon from London. It's 4 o'clock here. Wherever you are in the world, a warm welcome to this webinar. My name is Alan Lehman. I'm the Chief Executive of the Management Consultancies Association, and it's a great pleasure to work with Equiteq, our friends and associate members, on this webinar. Equiteq are going to be presenting their findings from their latest buyers research survey. They'll reveal what buyers and consulting firms look for and how they will determine value in 2018. Our presenters today are Steve Rabin, Managing Director of Global Health Practice at Equiteq, and Ramon Param, Associate Director. They'll be presenting for around about 50 minutes, and then there will be some opportunities for a Q&A session. If you do have any questions, do post them on the control panel to the right of your screen. The question box appears towards the bottom, and Equiteq have said that they will ensure that everybody gets a personal reply. So, over to you, Steve and Ramon.
Thanks, Alan. So, kicking off with a brief introduction on myself. My name is Ramon Param. I'm an Associate Director in Equiteq's Market Intelligence team. I lead much of the firm's thought leadership and look after many of our buyer relationships across the knowledge-intensive services industry. Before joining Equiteq, I worked with the Macquarie Group, and I was also a founding member of PwC's Global Corporate Development team, where I advised the accounting network on its investments across the consulting sector, including their transformational acquisitions of PRTM and Booz & Co.
Great. And thank you, Alan. This is Steve Rabin in New York. I'm a Managing Director at Equiteq, and I work with business owners to help improve their companies and also explore different paths to market, and also work with sellers that are looking for specific financial or strategic acquisitions. I'm a former business owner. Before joining Equiteq, I had started 2 strategic consulting firms, sold to 2 different international strategic buyers, and I also served on a corporate buy-side team for a WPP company.
So today's webinar will cover the findings from our 4th annual survey of buyers of knowledge-intensive services businesses. The webinar will cover our report's findings and also provide additional context and insights into buyer M&A trends, including some of the convergence trends that we're observing in the market, approaches that buyers are taking to deal structuring, and the typical window that exists for buyers to review a new acquisition opportunity. We'll also have a look at buyers' approach to evaluating new acquisitions and provide some specific insights we've gathered on their current valuation expectations in the market. Each year, we commission this buyer research to provide us with a unique perspective on buyers in the industry for the benefits of our M&A and strategic advisory clients operating in each of our 5 coverage sectors: management consulting, technology services, media agencies, engineering, and HR. This year, we commissioned an independent research team to survey senior management and those responsible for M&A at over 90 buyers. This year's survey was focused on questions around Equiteq's 8 levers of equity value. Now, these 8 levers are strategic factors that can drive value in your consulting business by enhancing growth, profitability, while reducing risk in the eyes of a buyer. Now, we call these strategic factors levers because we describe our equity growth program using the metaphor of a wheel, the equity growth wheel. By pulling these 8 levers, which we'll discuss in more detail during the presentation, you can increase the speed of a wheel and therefore the equity growth value of your firm. Now, with that introduction, let's take a look at some of the key findings from this year's report. So beginning with the M&A expectations of buyers, the outlook for deal flow in 2018 appears positive. The average number of acquisitions that buyers that we surveyed expect to be initiating over the next year had increased by 50% year on year. And that dovetails very much of what we're seeing in the market. A lot of the buyers that we're speaking with are conveying strong optimism over the next year in terms of the acquisition program. Our survey found that strategic buyers are expecting to initiate on average 10 deals over the next year, and that compared with 9 for private equity acquirers. Technology and management consulting buyers appear to be the most acquisitive across strategic industry segments. An interesting finding that also came out of this part of the survey, which is shown on the right of this slide, is the optimal target revenue size of transaction, and that was up significantly this year by over 50% to $63 million. Many prolific buyers that we're speaking with are telling us that they're currently focused on larger transformational acquisition opportunities that move the needle for their consulting business and help them to achieve more quickly their growth targets. So that's likely to have contributed to this trend. Now, on the supply side of deal flow, around 85% of buyers that we surveyed are seeing more or the same number of acquisitions as compared with last year. Now, this proportion is in line with what we have seen over the last few years. But what is interesting this year is that those buyers seeing fewer opportunities are also seeing larger deals being presented to them. And that may reflect those prolific buyers that I mentioned on the last slide that are now targeting larger transformational acquisitions and possibly having fed that back to their sell-side M&A advisors and brokers that they're in dialogue with. This has resulted in them being more selective on the deals that they're showing these buyers, which means that they are being shown a lower volume of deals, but deals that are of a larger size. Most buyers have told us that on balance, they're seeing a more competitive market for deals than they had done last year. So the increased demand for new deals appears to be outpacing the number of new deals that are being presented to buyers. So again, I think that makes sense given the large pools of capital that's being made available for acquisitions that we're tracking amongst listed players and private equity investors in the sector. And those pools of capital made available for acquisitions in the consulting sector are now approaching a 10-year high. That's likely to have contributed to this competition that we're seeing in the market. This competitive dynamic has the potential to support valuation increases over the next year, particularly in the hotter spaces of the market where we're seeing the most competition to do deals. Now, this increasing competitive tension in the market appears to have also impacted the length of earnouts that buyers are targeting on new deals. So as we can see here from this bar chart, the length of earnouts that buyers were targeting in 2015 was around 3 years, and now it's closer to 2.5 years. And that indicates a more competitive market where buyers are being pressured to present more competitive and attractive deal structures to get acquisitions done. Another interesting trend that we observed in terms of buyer demand for acquisitions was convergence between adjacent segments of the consulting market. Now, this is a trend that we have been monitoring and talking about in much of our recent thought leadership over the last couple of years. And we continue to see interesting deals emerging across different adjacent segments of the consulting market. And as we can see from our recent survey findings, there continues to be strong demand from strategic buyers across adjacent consulting industries for management consulting capabilities, which is where the dark red shading is in the top row of this heat map. Management consulting capabilities typically act as a tip of spear acquisition to enter new markets for buyers in adjacent segments of the knowledge-intensive services industry. So that can be very appealing for them. We can also see from the second row down in this heat map that IT services continues to be a hot segment for convergence. And we would expect that given that those buyers in adjacent industries looking to gain a larger wallet share of consulting projects with a strong digital component will be looking to acquire strong technical capabilities in IT services. Furthermore, I think a notable trend from the heat map is that there continues to be a lot of convergence at the intersection of management consulting, technology services, and media and marketing. And customer experience remains a crucial focus of many businesses' digital transformation initiatives.
And I spend a lot of my time working with buyers and sellers in the health field, and certainly this convergence trend in health is profound. The payers and providers in the health field, certainly the U.S. market, are extremely driven towards having to prove value now, and that's also true certainly in the UK with the NHS. And so the buyers are now looking not only at strategic consultants, but they're looking at data analytics, those who are purveyors of data sets, digital marketing firms, digital health firms, as all able to help them develop the value proposition. And they're looking broadly to figure out how to do that well.
As we finish off this section on buyer demand and come on to how buyers are evaluating opportunities, we thought it was worth just discussing a final interesting finding from this part of the survey. We asked buyers how long they would consider a target as being of strategic importance to them before moving on to a new opportunity. We found that almost half of buyers move on from an acquisition after 12 months of evaluating it, and 65% of buyers will only wait 2 years to consider a specific acquisition opportunity before moving on. Now, this probably represents the time at which most prolific buyers will have filled a capability gap with another acquisition and then diverted their attention to integration of that business that they've acquired, as opposed to making further deals in that space. And that's an important consideration for sellers considering testing an offer received from a buyer or waiting a few years to develop your business further in anticipation of that same buyer still demonstrating the same level of interest in a few years' time. Great. So now moving on to the next section of our survey, how will buyers view and value your business? As mentioned at the start of the presentation, we considered this part of the survey with a focus on our equity growth wheel and its 8 levers of equity value. So these are market proposition, which is about the value attached to how well your consulting firm is able to command market attention in comparison to its competitors. Sales and profit growth, client relationships, quality of fee income, which is about the value of long-term and well-diversified client revenues, intellectual property, which is in relation to developing tools, data sets, and also systematic approaches to innovation and knowledge management that can enable growth and scale across a larger organization. Developing sales and marketing processes across the firm, demonstrating consultant loyalty, and finally, management quality. From our survey, the levels of importance attributed to each lever varied considerably, as we can see from this heat map, between buyers, but also between buyer groups. In aggregate, there is particular importance based on quality of management and a company having a differentiated market proposition. Nevertheless, our survey indicates that there are elements of each of the 8 levers that will have an impact on how a buyer will evaluate and ultimately value your business. So all of them are important in different measures.
We have a poll.
Yep. Great. So the next, before we move on to the next bit, which is in regards to market proposition, we're going to run a brief poll. So the poll is in regard to our first lever, which is market proposition. And we wanted to ask everyone a few questions in regard to how you think market proposition might impact the value of your consulting business in the eyes of a buyer. So how would you expect an excellent market proposition that is of value to a buyer to impact the valuation of your business? Negligibly, 5% increase in value, a 10%, a 15%, a 20%, or an over 25% increase in value. So we'll wait a moment and just wait for some results to come back, and we can discuss that in the context of our first lever.
I think folks have voted, you know, what the survey showed is that buyers are really looking for firms that have settled their course with a clear market in mind and a crisp articulation of the benefit they offer to that market. This this is really, really important to both financial and strategic buyers. And from the survey, we found that a clear market proposition can add about 15 to 23% to a firm's final valuation. As I mentioned, I sold 2 firms, and the last one was a strategic consulting firm. And about 2 years out, we did an equity growth workshop with Equiteq. And while we thought that we really had a very clear, crystal clear market proposition, we found out to our chagrin we had a lot of homework to do. And what we learned is that in our efforts to grow revenues, we had tried to be all things to all clients, and we weren't as disciplined as we could have been in choosing a clear growth strategy. That firm's unique niche in the market was market access for underserved populations. But in our efforts to drive revenue and try new things, we're also chasing general marketing and public relations assignments. So for several months, our management team had to make some very hard choices and jettison some of the off-strategy offerings to really get to a clear, unique value proposition that buyers were going to be looking for. The other important piece in the lever is growth and financials. Buyers are looking for your top and bottom line growth. But I'd say from our experience, they're most interested in the top line. It's a key metric, and it's a great measure of if your market proposition really has value. Are you getting traction in the marketplace? And financials also the place where buyers are looking to measure what their risk is for an acquisition, and rapidly growing revenues forgive a lot of sin and reduce the risk of failure for the buyer. Less consistent margin growth could be for several reasons. I think buyers tend to be pretty understanding, want to hear the story if your margins aren't growing, your profits aren't growing as fast as your revenues. And they also look at them a little less related to the long-term viability of the firm, something that can be addressed through better operations or things that you'll get, particularly from a strategic acquirer, and then also financial acumen you may get from a financial acquirer. Moving on to the next lever, client relations. Long-term client relations and blue chip clients on the roster are the first things that buyers do look for. They're very important. But increasingly, buyers are looking past that and wanting to understand what level businesses are working on with their clients. Are the firms dealing with the chief marketing officer, a brand or a franchise manager? Are they in the C-suite? Do they have a relationship with the CEO? One of the things we're seeing is a very important dynamic, going back to Ramon's observation about convergence and the rise of data analytics. The decision-making dynamic inside a lot of the buyer's customers is changing. The CFO, for example, is becoming more important for purchasing and directing strategic consulting services. The CEO is seen as possibly the last vestige of innovative, non-data-driven decision-making. So buyers are going to want to know how an acquisition candidate is adapting to these changes in decision-making in their clients.
So moving on to our next level of quality of fee income, we found that 60% of board-level respondents in our survey described quality of fee income as being very important. And that was even higher for private equity buyers. We place a high degree of importance on repeat revenue streams, because that really increases their scope to raise debt finance post-acquisition, which is an important tool used by this buyer group to boost their equity returns. With respect to client concentration, which is the other element of quality of fee income, we typically see the risk of key client dependency and attrition as being an important consideration amongst buyers on our sales process. Across respondents, on average, over 24% of revenue from a single client was seen as a concern for buyers, broadly in line with our surveys in prior years. Both recurring revenue and well-diversified revenue streams across different clients can improve the accuracy of revenue forecasting, which is important for buyers to gain confidence in a seller's management and their projections. And as you can see from the pie chart to the right of this slide, there's a variety of responses with respect to how many months ahead a target should be able to accurately forecast their financials. But on average, the minimum period that a buyer would expect a seller to be able to accurately forecast their financials was 12 months.
Moving on to the importance of intellectual property as a driver of value, you see here in the findings that roughly 50% of buyers say that codifying a firm's intellectual property can very significantly affect purchase price. What buyers are looking for here is to see if the creative idea that created the business is woven into products, and also how the entire staff markets, delivers, and manages the work. Certainly, traditional components of IP, proprietary data sets, proprietary software that can provide service delivery, drive high value, particularly in a convergent market or market focused on convergence. But they're looking at the mechanics of IP inside firms as well. Buyers want to see how you go to market with intellectual property. They want to look at thought leadership. They want to see the owner and senior managers out in industry gatherings. They want to see proprietary and peer-reviewed publications with a unique point of view. They're looking at, have you taken your intellectual property and woven it into every part of delivery? Are you delivering services consistently with the same language and format across all clients? And for some strategic consultancies, this is always a challenge. I've seen this as a struggle when CEOs have creative managers who are managing client relations who really are bringing their own styles to the work. And the upside, of course, is that innovation is extremely healthy in a consulting firm, but this type of freelancing could also be depressing the value of firms' intellectual property in the eyes of a buyer. And then another dimension to IP is, are firms managing with an eye towards IP in terms of hiring individuals, candidates who can best implement the firm's uniform approach? What's the onboarding of IP to new hires to really allow them to deliver uniform services and quality across all clients?
Now, moving on to our next lever, which relates to how effectively a business is developing its sales and marketing processes across the firm. We asked buyers whether they would be concerned if these sales and marketing functions were carried out in-house or by subcontractors. Across business functions, subcontractors were generally seen as having a negative impact on valuation. And as you can see, the only exception to this was marketing, finance, and operations functions amongst strategic buyers as having less of a negative impact on value. And that probably relates to the fact that subcontractor functions in that regard can be easily rationalized within a buyer's own functions if they're looking to enable cost synergies. So in that case, it won't have a negative impact on value. Now, before we move on to our next level on customer loyalty, I just wanted to run another brief poll and ask everyone what percentage of either stock or phantom equity you have distributed to the key management and people within your firm. So the options here, I believe, are 0 to 10%, 10 to 20%, 20 to 30%, and over 30%. So I'll wait a moment and let some responses come back, and we can discuss them in the context of the next level. Excellent. So the results are in. Interestingly, the majority of respondents here, 56%, said that they only distribute between 0 to 10% of their equity to key management. There is responses above that, but the majority is quite low at 0 to 10%. Now, in our survey, buyers told us that they're looking for at least 23% of equity to be shared amongst key people within a seller's business. And that varies, as we can see from this pie chart. So there are some. There is a decent proportion of buyers that are looking for equity to be distributed to key management at a proportion of 50% or above. But on average, it's 23%. So with respect to equity incentivization, buyers will want to see a management team that is already incentivized leading up to a deal. And ultimately, where equity isn't being appropriately shared with key management or key people within the firm from the eyes of a buyer, but they still want to proceed with the transaction, they will expect a proportion of value to be set aside typically for an employee retention bonus. So that will reduce the consideration that is left for you as a shareholder. So it's important to be thinking about aligning incentives appropriately with key people within your firm before you're going to market. Now, with respect to consultant loyalty, we also ask buyers about acceptable turnover rates and staff. So the pie chart to the left of the slide is looking at the results there. On average, buyers expect attrition rates to be below 19%. But again, as you can see here, this figure varies considerably amongst buyers that we surveyed. We would expect a buyer will typically see a low employee attrition rate that's been connected with strong knowledge management and a strong team culture. That can be leveraged through acquisition to hire more and retain more quality people to deliver the buyer's growth plan. So it's seen as an important metric that they will look at during the sale process.
And just an additional amplification on management quality. As you can imagine, buyers at the end of the day are buying a management team. So they very much want to look under the hood. They want to have a good understanding of how the management team functions against key drivers of success. And specifically, they'll be looking at who the rainmakers in the firm are. And the more they see that beyond just the owners of the firm and down into the ranks of the management team, that will drive interest and value. They are also looking for top client relationships being managed by others beyond the owners. One of the risks that they're managing for the future is owners may, at the end of an earnout, leave. And so the real value of the business often is in retention of senior managers over the long haul and giving them career opportunities after an owner may have moved on. This becomes an extremely important part of the conversation, a part of buyer meetings when they really want to see who's going to be running this business for the future.
So finally, wrapping up with valuation insights that we gathered as part of the survey. As we can see here, we've got some of the average results that we gathered at different growth rates of an illustrative acquisition opportunity, and the adjusted EBITDA multiple that buyers would be looking to expect to be paying for that business. As we would expect, there are steep increases in value expectations for buyers when they're considering higher growth businesses. And that really highlights the opportunity for many sellers to be potentially adequately compensated for future growth in your business if you are currently experiencing an uptick in growth. Another interesting finding from the valuation survey responses was that core members typically have lower value expectations than non-board members. That highlights the importance of positioning the value of your business and the acquisition opportunity with the key decision makers at a senior level within each buyer. And those will be the people that will ultimately be having the final say on the offer that's being made. So finally, just wrapping up the webinar and what we've spoken about. In summary, there is very strong buyer demand and robust upward pressure on valuations for a wide variety of consulting sector acquisitions. Buyers are also looking at broader choices of acquisitions, as we saw from those convergence trends. So that's creating more options for sellers in terms of the different buyers that might be interested in their firm. There are a variety of factors that we've discussed impacting buyer interest, and that highlights the importance of carefully preparing the business for sale and appropriately positioning it with the right buyer. Ultimately, it's a demanding process, and it requires a significant time commitment and a wide array of deal process skills as you're going through a sale process. If you'd like to discuss anything that we presented in further detail, please feel free to get in touch with us. And at that point, I'll hand over back to Alan for any questions that have been presented during the webinar.
Well, Steve and Ramon, thank you very much for that. It's an extremely interesting presentation, and you quite very interestingly tied it into your equity growth wheel and walked us through the 8 elements of that. I suppose my first question to you would be, you talked a great game about what great performance looks like. If we're going to be a bit self-critical, not every consulting firm will be doing brilliantly in all 8 of those, and may be thinking that they've got some room for improvement in some areas. Is that a barrier to a sale? Is what you're saying that you should really develop yourself on that equity wheel before you consider going to the market, or can you go there, as it were, with some relative weaknesses?
Alan, that's a great question. I mean, among the 8 levers that, starting with the financials, buyers are really going to require a certain financial floor in terms of size and growth before really engaging. So that's a key gatekeeper on even going to market. But once you've passed that minimum sort of threshold, good buyers are not going to expect everything to be in top shape, and they understand that one of the reasons you may be selling is to work with a large organization that can help you improve your business on some of those characteristics. Of the 8 levers, once you've passed the financial threshold to have a conversation with buyers, I'd say if you feel at all wobbly on your market proposition or the cohesiveness of your management team, that would be a place you should pause before engaging the market.
Great, thanks very much. One other point that really struck me when you were presenting the findings was around the average revenue size of firm that buyers were seeking to acquire. I think you said it was $63 million now, and that strikes me as being quite high and quite a big barrier for many firms to pass. What's your advice to firms that are below that, and might be some way below that?
I think Alan, I agree with you. $63 million is probably quite a high average, and probably represented the responses of some of the larger prolific buyers that were responding as part of our survey. If you take a look at our most recent M&A report, which covers transactions that occurred over 2016, you'll see that over the last 10 years, the median deal sizes have been much smaller year to year. And from our own experiences, we typically see pretty healthy buyer interest for sale-ready businesses that are over around $10 million in size. Typically, above that threshold, you'll get decent enough buyer interest if a business is sale-ready. But as mentioned in the webinar, regular buyers are typically looking for larger transactions, and they will typically pay a premium for businesses that are higher than that threshold. And reasons for that might be that they're moving the needle for the acquisition strategy. It's enabling them to get growth a lot more quickly. They can cover more of the fixed costs of acquisition and integration. So that makes it a lot more attractive for them. Also, larger businesses are typically associated with having more established brands in the market, relationships and infrastructure that can be attractive to buyers. So for those reasons, they might be looking to pay higher multiples, and also to command more interest as we're looking at more sizable transactions towards that $60 million mark.
Many thanks. A couple more, if I may, while I'm on a roll. What's your advice to firms? A number of firms might find that as they're in the process of considering a sale, that they could suffer a hit, and in the UK at the moment, we're very conscious of a bit of element of economic uncertainty and political uncertainty, and firms might lose a key contract because of that, but nevertheless want to continue with the sale. If there is a loss of revenue in that because of that, how will it have an impact?
Sure, Alan, that's common. The buyers are reasonable folks, and the first question is they'll just want to know why. And buyers in the market are extremely familiar and also forgiving with typical client life cycles, and also unexpected events that can happen on the client side. A change of management, the chief marketing officer moves on. What they're going to be concerned about, and will likely pass on an opportunity, if the client loss is really signaling a weakness of the firm's offering to the market, or they're somehow being signaling a loss of competitiveness. If they're looking at that, and then they're hearing the story, and what they're seeing is a loss of traction, that is going to give them pause, and something that a seller is going to have to think through how to talk about that, and what does it really mean, and also be honest about, is that a signal that the value of the firm isn't what the seller wanted, and be able to have a realistic conversation with the buyer.
Great, many thanks. Last one, if I may. You stressed the importance for buyers of a properly incentivized senior management team, perhaps with equity holdings in the firm, and that was one of the things that would make a firm that bit more attractive to buyers. If firms are considering how to organise that, what are their options?
Sure. I think the two most common used are either stock grants or phantom shares or phantom equity. And most business advisors, you'll talk with, they're going to steer you to consider phantom equity, which creates a realization for the managers only in the situation of a sale. And phantom equity can also be tied to employment. So if the person leaves, the phantom equity percentage that you were allocating to them leaves with them, or rather is shut down and becomes available to other employees. Stock is a little more difficult to work with, depending how it's granted and how the options are structured. But generally, you're going to possibly run into a situation where an employee leaves and still has ownership interest in the company, and that's going to frustrate the seller's ability to incentivize the right people through the earn-out period, and the buyer's going to look at that saying, well, I never met that person, and they've gotten a significant amount of value out of this sale, but what about the people that I'm going to be working with? There are many ways to structure stock and phantom equity plans, and the good ones, Alan, I think take into account the diversity of earn-out strategies that buyers use. Some buyers are incentivizing growth in the acquisition, others are incentivizing profit, others have sort of hybrid. It looks at management team career trajectories. Management teams, you might have star performers that are very early in their careers, and what will be an important realization for them may look very different than somebody who's looking at this as the final part of a career, and they're looking forward to retirement at the end of an earn-out period. And so looking at those career trajectories individual by individual, and also really having an understanding of the life stage of each manager can be an important part of shaping just the right plan for a company.
Great stuff. Thank you very much. I think we're going to call it a day there. And I don't know about you two, but in my experience, from my years in consulting, nobody has ever complained when something ended early. So we're going to end just a few minutes before the advertised time. But thank you very much, both of you. To remind everybody, if you did ask a question that we haven't answered, or if you have any more questions after the webinar, do get in touch with Equiteq and we'll want to discuss any aspect of what Steve and Ramon have been discussing today. Also, as you can see on the screen, and I strongly recommend this, if you're not already a member, do sign up for the Equiteq Edge Club, which is full of information for consulting firm owners, full of research, buyers research reports, M&A reports, webinars and articles, which will help you with a lot of the issues which were raised today, and is just a fascinating resource for the industry. So with that recommendation, could I say thank you to both Steve and Ramon for your presentation. Congratulations on the survey and for the very, very clear presentation, and thank you to everybody for participating in the webinar.